Hey, welcome everybody. I'm Ted Earhart. I want to spend a few minutes today talking about this GameStop situation that played out in the markets just a couple weeks ago. I know it's on people's minds. I've had a few questions about it, including from one of my relatives who doesn't follow the financial media, doesn't have a smartphone, doesn't even have an internet connection for that matter. And I know if he's got questions, paying attention to this, it probably means nine out of 10 Americans are. So real briefly, first of all, what is GameStop? Well, GameStop is a traditional retailer that sells video games, game consoles, etc. And like many retailers, it's found its business under significant pressure in recent years as more and more shopping shifts online. The company's lost money, and it remains an open question as to whether their business model is even going to be viable going forward into the future. As a result, the company's stock price has been weak. It's been going down in recent years as they've lost money. But something extraordinary happened in late January. The stock price basically shot to the moon. Just literally 6 months ago, the stock was trading in the $4 per share range. And by the end of January, it hit a closing high of just shy of $350 a share. This actually understates the all-time high, which we kind of call the intraday high. The next day, GameStop actually peaked out at $483 per share before closing down below this previous closing high. And just to put some dollar figures around this for fun, had you put $10,000 into GameStop stock, again, at the end of the summer in August, it was around $4 a share. Well, at the very peak, at the highest tick, $483, that $10,000 was briefly worth just shy of $1.2 million. And naturally, this is why it captured so much media attention. Now, it's an exceptional story. To be honest with you, when I first heard about it, I just kind of dismissed this as some speculative bubble that was due to pop. And it basically has, as you can see on the chart, much of the gains have been given back. But a friend of mine who's a professional money manager called me and said, look, there's a really interesting story behind what happened here. You should really check this out. And come to find out what really happened was there's this group of individuals, and apparently in this instance, it was mostly teenagers, people in the early 20s, who are chatting on the Reddit platform. Perhaps you're familiar with that. And there's a group specifically known as Wall Street Bets where people talk about investment ideas. And these people got together and they basically said, we are going to purposely run up the stock price of GameStop because there's a whole bunch of Wall Street hedge funds that are betting the stock price is going to go down, and they are trying to profit off that. So we're going to try to inflict some major damage on them, i.e. major losses, by running up the stock price. It's kind of this classic David versus Goliath situation. And long story short, it worked. There were a number of major hedge funds, some very prominent ones managing billions of dollars, that were brought to their knees and had to raise outside money just to survive the month of January. So it's an exceptional story. I won't be surprised if books and maybe a movie are made of what we witnessed at the end of January. So if you're asking yourself, how can a bunch of teenagers basically bankrupt some mega Wall Street hedge funds? To answer that question, you need to understand short selling, and that's basically part 2 of this video. So everybody is familiar with what we call going long. And in going long, that's just a traditional investment. In this example here, if you invested $10,000 in a company like GameStop, well, your upside is theoretically unlimited, as illustrated. The nice thing is your downside is limited to your initial investment. So in a worst case scenario, the company goes bankrupt. Well, you lose your $10,000, but no more. When you go short, in contrast, the opposite is true. Your upside is limited to your initial investment. So the best you can do with a $10,000 short bet is double your money. 10,000 becomes 20. But the most important point here is on the downside, your losses are theoretically unlimited. And that is the key point, and that's what got these hedge funds in trouble. So to do a short bet in the stock market, what you're actually doing is borrowing stock, selling it today in hopes of buying it back in the future at a lower price. Now, this is hard for many people to get their mind wrapped around, so I was trying to think of the best example to kind of help people comprehend it. And this is what I came up with. It's just kind of a funny story. I don't think anybody would actually do this unless they were like Tom Petters or something, but bear with me. Just imagine, for example, that a friend of yours was going to go on a 5-year world tour and entrusted you with his classic Corvette. And for whatever reason, you strongly believed that the price of these cars was going to be going down. Okay, the car was worth $30,000 when it came into your possession. But again, you believed it was going to go down in value. So what you decided to do was sell your buddy's car and pocket the $30,000 today with the intention of buying it back before he returns, hopefully at a lower price. And let's just say you were correct and you were able to buy the car back for $20,000. Well, the difference between the two, this is your profit. You sold for 30 and bought back at 20, you just pocketed $10,000. Everybody's happy, right? Well, that is a short bet. That's what short sellers are trying to do with companies' stock prices that are declining. Again, the problem is if you're wrong, you can be really wrong. And let's just say in our example, we'll move on to our last two columns here. Imagine there was some Hollywood movie that glorified classic Corvettes, and all of a sudden demand surged and prices of these rocketed upward, and your friend is now ready to return from his world tour, and this car, to buy it back, you now have to pay $250,000. Well, your losses, as you can see, are you got $30,000 up front, but now you got to shell out $250,000 to get this back. You've just lost $220,000 or 733% on your investment. This is a short bet gone wrong. In the case of GameStop, the price explosion was so extreme, like literally the stock went up, 100-fold or more at the peak. Just to put that in the context of our example here, imagine $30,000. Imagine you all of a sudden having to come up with $3 million to buy this car. Well, you made a $30,000 bet and basically lost, just shy of $3 million in an extreme example like we saw with GameStop. So this illustrates the dangers of short selling. And it also illustrates how a whole bunch of teenagers got together and nearly put a bunch of these major Wall Street players into bankruptcy. Even if you did a short bet, it's just a small percentage of your portfolio. If things get extreme enough, you could wipe you out completely. So I hope you enjoyed the video today. It's kind of interesting. Drop me a comment. Let me know if you enjoyed it. If there's anything else out there on your mind that we can comment on. Thanks for watching.